A very important concept in any type of trading is the bid-ask spread. So what is the bid-ask spread? Well, we can start off by explaining what is the bid and what is the ask. So the bid is the highest price that a buyer is willing to pay for an asset, whereas the ask is the lowest price that a seller is willing to accept for an asset. And how could we keep this in our head straight? Well, if you're wanting to buy something, you're wanting to pay the lower amount. So the bid should always be lower than the ask, and that is what the buyer wants to buy for. Now, if you were going to sell something, you would want to sell for a higher amount. So the ask should always be higher than the bid, and it is the amount that we want to sell something for. That being said, what is the bid-ask spread? So the bid-ask spread represents a transaction cost, and it is a way to measure market liquidity in a way. So in our example, where we had the ask of $3.05 and the bid of $3, we can find the bid-ask spread by just taking the higher value, so we'll take the ask, and then we'll subtract out the value of the bid, so the 305 minus the $3, and we're left with a spread of just 5 cents. The higher this spread, we would say the higher the transaction cost. Another important concept is the order book. So what is the order book? Well, we can see a representation of what one might look like over here. So the order book contains two things. It contains a list of bids with the highest at the top and the lowest at the bottom. And then it also contains a list of asks with the lowest at the top and the highest at the bottom. So the best deal, if I want to sell something right now, would be the bid at the top that I could get. Whereas if I wanted to buy this thing, the best deal I could get right now is to buy it for $3.05. Now imagine that there is just an order sitting here in the order book. Someone is willing to buy this from me for $3, and then I sell it to them for that amount. Well, now this might be out of the order book, and now the next best thing that anyone could sell one of these assets for would now be $2.99. So basically this one would go shift up to the top, and it would shift up like that. And so this order book will constantly be updating with people putting in new orders. We can say that the order book plays a central role in matching buyers and sellers. So what drives bid-ask spreads? We know that transaction costs are higher when bid-ask spreads are wider. So what might cause that to be the case? Well, one of the key things is liquidity. So higher liquidity typically results in tighter spreads. That would mean that with lower liquidity, we would have wider spreads and more transaction costs. Now, another important thing which goes hand in hand with liquidity is the overall trading volume. Typically, if there's more trading volume, there will be more liquidity. So assets with higher trading volumes often have tighter spreads due to increased competition among buyers and sellers. So higher trading volume, tighter spreads, lower transaction costs. Whereas lower trading volumes should have wider spreads, which would be higher transaction costs. And finally, volatility plays a role. So higher market volatility will lead to wider spreads typically as market makers price in greater risk. So now we can see an example of this with the largest S&P 500 ETF known as SPY. I'm going to go over into the top left and search for SPY and click on that. And now I can click on option chain if we want to look on options on this ETF. So we can see that the current price of the SPY is $584.45. Now we can go down and find the option with the strike that is closest to the price. So this is the at the money option of $584. Now I'll click on that and we'll see that this option, if I scroll down, we'll get some indication of the overall volume. We can see that for this option, there's volume of 254,000. So now we can see that the spread is just 1 penny. So if I wanted to buy at the bid, it would be the spread between the bid and the ask is only 1 cent. So that's a pretty low transaction cost. Now let's look at an example where let's say there's one where this has a bid-ask spread of 12 cents. So remember, the volume on this one was 254K. Now let's look at the one with the spread of 12 cents between the bid and the ask. And we can see that the volume on this one is 9,000. Compare that to the more than 250K, the other one. So the lower volume seems to have resulted in a wider bid-ask spread. This video is a part of my course, Options Theory to Practice. I'll guide you step by step through the fundamentals of options, all within a safe and controlled paper trading environment where no real money is at risk. You can learn more via the link in the video description or pinned comment.